Leanne Clements, Head of Responsible Investment at the People's Partnership, the UK's largest independent master trust. Welcome to Sustainable Investors Asset Owner Interview Series. Thank you for taking the time.
Thank you for having me, Chris.
Um, a lot of these interviews recently, Leanne, have centered on or they've touched on the structural integration of sustainability factors into asset owners' investment decisions and how they operate more broadly. So let's start by looking at how the organisational structure at TPP ensures an efficient and effective level of integration.
So I'll start at the top and work my way down in answering that question. First, we have an overarching governance structure regarding our relationship with the trustee of People's Pension. The investment team at People's Partnership, and we call ourselves People's Investment Limited, or PIL, is the official advisor to the trustee of People's Pension. In addition to being the owner of the scheme's RI policies, the primary role of the responsible investment team is to be an internal advisor to the investment team. And as head of responsible investment, I am a member of the senior investment team. And then underneath that, we have a robust internal governance process in the lead up to any strategic item being presented to the trustee. The responsible investment team are asked to formally opine on any strategic item as part of the advice that we provide to the trustee. And this reinforces the importance that responsible investment is given to any key investment decisions that we make. And then underneath that, we assure that responsible investment is part of the wider scorecard on how we select, appoint, and monitor our managers.
Okay, fantastic. That gives a good structural kind of background to the operations and the conversation. Now, for a key focus for TPP and all asset owners, I guess, is addressing those kind of systemic risks that undermine or have the potential to undermine returns of diversified portfolios. So, for you, what would you say is the kind of maybe the key main barriers in addressing these interconnected systemic risks such as climate change, and how are you addressing those barriers?
So I'll just set the scene on answering that question by highlighting the World Economic Forum's Global Risk Report. They refer to polycrises, which refer to a series of crises that amplify each other, and it creates a combined impact far more severe than the sum of their individual effects. And in this report, in the yearly report, they provide a map showing all the interconnections. And the bigger the node in terms of area, the more interconnections that particular crisis has. And I've highlighted that because to me that provides the perfect lens by which we should be tackling the various sustainability risks we face, and notably the ones that are systemic in nature. En masse, I think we lack the analytical tools necessary to do this. They are very siloed in terms of how they evaluate risks. And if we don't address this, we're leaving risks off the table that we're not addressing. Uh, and so one of the things that investors can do to help is to create incentivization structures in the mandates that they have with ESG data and research providers and other relevant actors in the investment chain to drive the necessary innovation in this space.
So, to what extent? I mean, just following on. I mean, when there are, when we're faced with kind of polycrises, how much is resourcing both at the asset owner, asset manager level, a kind of big barrier?
Well, with the rise of system stewardship, the expectations in this area are becoming much more complex. And then in turn, this demands a real evaluation and resourcing, not only from a headcount perspective, but also in terms of skills, market coverage, IT, and so on. And the asset owner statement on climate stewardship, which we led on alongside Brunel and Scottish Widows, also recognizes this. At People's Pension, we have included appropriate stewardship resourcing as part of our minimum requirements for listed markets, which we thought was an important consideration given the industry recognition of underinvestment in this area. And in acknowledgement of this, the PRI and Thinking Ahead Institute did some really great work in this area a couple of years ago, which I really encourage people to read. Um, there is no definitive rule book, though, for appropriate stewardship at the present time. It really is an art rather than a science in broad terms. One needs to be flexible, of course, about what best practice looks like across mandates and asset classes, etc. However, I think it's much easier to identify optimal practice. So I'll give you a few examples of what I mean by that. Let's take headcount, for example. in an index mandate, whether you have 40 staff, 50, 60 stewardship staff, can be considered optimal is tricky. Whether that's considered optimal is tricky to prescriptively land on. But we have a reasonable comfort level that less than 10 staff is probably not adequate. And then another example is market coverage. Knowing the exact number of people needed in key markets is tricky as an asset owner holding a fund manager to account for this. But if certain key markets have no staff at all, that might be a red flag because local presence does actually matter. And then finally, if you're looking at, for example, sectoral and thematic expertise, I wouldn't want to be too prescriptive as to the exact numbers of each in holding my fund managers to account. But if the balance is materially leaning towards one versus the other, that may be another red flag that deserves further exploration.
Okay, so if we're moving more to a more systemic approach to stewardship, what are the kind of practical implications of that? Obviously, we tend to think of engagement as very much kind of corporate focused, maybe how many resolutions you're voting on, but if you're prioritizing systemic stewardship, how do you measure the asset owner's impact there?
Yeah, I mean, the whole sort of X number of companies across X number of issues as a demonstration of impact resonates with me strongly. In my view, this is no longer fit for purpose if used in isolation to demonstrate impact. I mean, ultimately, to address the sustainability challenges that we face as investors, we need a sea change from a lot of companies. So the problem we need to solve is we have limited stewardship resource. We want to make sure that we're allocating resources in the most effective areas to deliver maximum impact. And I'll mention a few areas that asset owners can prioritize in their monitoring program to address this. The first is, and this is principle one of the asset owner statement on climate stewardship, is the proportion of resources being spent on industry and policy engagement versus individual company engagement. Now, there are no fast rules for this, but your instinct should tell you that if a fund manager is spending over 90% of their time on company engagement versus industry and or policy engagement on addressing systemic issues like climate, in my view, that's a problem that needs unpacking. But this does represent a wider industry challenge. And so one needs to be pragmatic as to what you can achieve over the course of the mandate. It may take a while for an entire industry to shift its thinking around this. For me, at a base level, this is an efficiency argument. Instead of engaging with each individual mining company, for example, you work to raise the standards of the whole industry, like what happened with the Global Investor Commission on Mining 2030. The next thing to look at a company level is the robustness of that prioritization framework. It needs to be tested. So you need to ask your fund manager, what is their theory of change for their stewardship resource allocation? Again, the asset owner statement highlights this as well and identifies a few focus areas for further scrutiny to test that prioritization framework. For example, on fossil fuel resilience, are they spending a disproportionate amount of time on the supply side and not enough on the demand side, company engagement? Because there is a theory of change that says if you solve demand, supply will follow. And then let's take a look at transition plans. Are they diluting their signal to companies by referencing too many transition plan elements in their engagement? Have they prioritized critical transition plan elements like, for example, CapEx or lobbying, that if successful in their engagement, that will drive maximum impact than having an engagement in which you're touching on, say, 10 transition plan elements, for example? And then last but certainly not least, which is a real priority for me at the moment, is around improving reporting. And this ultimately requires a partnership approach between the asset owner and the fund manager. But this requires a few things. First, us as asset owners, we need to align our own reporting requirements to the extent possible to reduce that all too talked about burden of bespoke, requests that are coming from asset owner clients to fund managers. And then asset managers themselves need to, of course, be amenable to having their clients coming together to shape what they want. And they also need to recognize that they need to get the ingredients of reporting right first before jumping straight to reporting on stewardship outcomes. Things like, for example, improving proxy voting records. Now, Pensions UK's vote reporting template is very useful here. Having internal systems to support milestone tracking and voting escalation holistically together, not separately. And codifying company follow-ups to determine impact of successful engagements and so on. And all of this needs to be communicated to clients in the most meaningful way, which I admittedly is quite tricky to do, is a work in progress at an industry level, but we need to prioritize it. To me, in my world, the ideal scenario is to have a software platform of voting and engagement data that clients have access to, and then they can produce various bespoke reports on the back of it. The asset owner client in that scenario gets exactly the reporting they want, but also it's reducing that burden on the asset manager side. And there are lots of stewardship platforms out there that can offer this. And so there's been incredible innovation in reporting over the last few years. So I'm quite optimistic about being able to drive this positively moving forward.
Mm-hmm. So just on that reporting point, clearly you're suggesting that this is an issue that the industry needs to fix itself rather than rely on any kind of regulatory kind of leadership.
Well, I think there is some regulatory leadership here with the Stewardship Code example, but I do think the onus is on asset owners and fund managers to come together with respect to those granular sort of reporting requirements. And as I said, I think these stewardship platforms have an interesting role to play in that.
Absolutely, absolutely. In terms of other aspects of the structure of responsible investments and the kind of relationships with between parties to address systemic risks. You've done a lot of work on the making sure that your asset managers are aligned with your own responsible investment policies. And a lot of that has been around design of segregated mandates and investment management agreements. Please do kind of share a little bit more detail on how you went about that and how stewardship issues have been embedded in that and what are the results from these efforts so far.
So, I mean, in my view, this is an underutilized mechanism in the industry, and I really do want to give a shout out to ICGN's Model Mandate Initiative, which I think is a useful starter for 10 for many asset owners to drive embedding more responsible investment content into their contractual arrangement. Now, I recognize it cannot replace a robust due diligence and monitoring program, but codifying your expectations into an IMA, I think, puts extra teeth on that monitoring program. And it's also the point in the relationship where you arguably have the most influence. One of the key elements of our IMAs that I'd like to touch on is on the manager having to demonstrate progress against closing the expectation gaps identified during the due diligence process, and then producing a yearly report against that accordingly. Now, there may be some gaps, expectation gaps, that are unique to the relationship, which may be resolved over months or a year, for example. Reporting might be a good example of that. But there are a lot of expectation gaps that are reflective of wider industry barriers, which we've already touched on. And so yearly progress against those type of expectations are appropriate, with a full review happening over 3 years.
Leanne, as well as the work that TPP has done itself with its own asset managers, you've worked alongside a wide range of other asset owners in identifying broadly what the sector's evolving expectations are of asset managers on climate stewardship specifically. What has been the response of asset managers since that statement in this time last year, and do you expect and what further steps do you expect on this front?
So I'm very pleased to say that we've added 8 new asset owner signatories to the group back in the autumn for a total of 35 asset owners, and we're continuing to socialize the statement to other markets, and I suspect this will be a slow burn engagement for some time. We've also been liaising because we're coming up to a year since the original launch of the statement. So we're currently liaising with a few of the signatories to determine what impact the statement has had on their dialogues with managers. So examples of some of the questions we're asking people are, how are you using the statement? What's working well? What's not? What challenges have you encountered in using the statement with managers? How have you worked through any perceived or actual misalignment? And were there any principles in the statement more difficult to get comfortable with than others? And so what we're planning on doing after we're done with that engagement with those signatories is there's various options that we're exploring, but one could be that a report that we might produce, or we'll do a workshop with the wider signatory base and also fund managers, et cetera, to kind of build upon some of the themes that were identified during this initial engagement, just so that we can keep the asset owner statement live in the industry's minds, because I'm very mindful of various types of initiatives that are out there that are sort of set and forget, I guess you could say. a big splash at the time and then they sort of go dark, right? And I'm very, very mindful that, of that accountability part of all this, is that we need to be able to demonstrate what impact this statement has had, and that's very much the focus area at the moment for me and the team.
So presumably, though, there's a sense that this kind of setting of expectations by asset owners is a powerful and potentially very useful tool.
Yeah, I mean, as we said in the press release at the time, we're looking to embed efficiencies into the stewardship chain, right? When Brunel hosted a workshop on this a couple of years back, one of the key feedback we got from fund managers was, okay, you want us to align to you in terms of your voting practices, etc. But are you yourselves aligned as an asset owner community? We thought this was a fair challenge, and that actually prompted the development of the asset owner statement, right? And if we are at least aligned at a principal level as an asset owner community, I think that will help asset owners from the efficiency argument perspective, but also to empower the stewardship teams of managers to deliver on their client objectives.
No, we talked a lot about what asset managers should be doing and what the expectations of asset managers are in the kind of climate stewardship and engagement sphere. But how should asset owners' own approach evolve as we? I know that I've been talking quite a lot to one or two people about the increased focus on adaptation and resilience, perhaps. And I know you've said in the past that there perhaps ought to be an industry-wide review of the effectiveness of in particular climate policy engagement activities. I'm wondering where you think that a greater emphasis should be recognised in future.
Well, yeah, I mean, it's a really good question. I mean, ultimately, it's like, what does effective policy and industry engagement on systemic risk actually look like? And ultimately, to address systemic risks requires systemic intervention. The whole sort of letter writing signed by lots of investors has had some impact, but I don't think at the scale that we need. And a lot of investors use membership bodies. We do, like PRI, UCSIF, and IGCC as the primary lever for their policy engagement activities. And they do great work. There's no doubt about that. But I think more needs to be done. And we need to be humble about that as an industry. And I'll give you some examples about what more could be done in this area. First of all, asset owners themselves, as owners of capital, they should hold their fund managers to account for their policy engagement activities and set clear expectations on this in their monitoring programs. RRI policy acknowledges this. And I'd like to give a shout out to LCP. They've done some great work in this area, evaluating asset owners and how they're holding fund managers to account. So I encourage people to take a look at the work and the research they've done in that area. And then we also need to align our policy engagement activities, I think, with our sovereign engagement program. Now, the PRI's collaborative sovereign engagement work has highlighted the power that this can have, because at the end of the day, money talks and can bring the right stakeholders into the room. So I think asset owners should have conversations with their bond managers about how they're leveraging this power to drive change. And then we need to replicate the successes of other industry engagement initiatives like the Global Investor Commission on Mining, which I've mentioned earlier, to other critical sectors in the energy transition. Now, there's, at some point, some of the frameworks and the actions that are coming out of that particular initiative on mining may not apply to other sectors, but there's definitely some broad principles and lessons learned from that successful coalition that can be replicated, and I think that to other sectors, and I think that exercise needs to happen and prioritized by the investor community. And then the last point is around skills and governance. We should undertake an internal assessment to determine whether we have the necessary skills to drive effective policy engagement. Just because you're an RI expert doesn't necessarily mean you're also a lobbying expert. Do you have a policy and public affairs team? And if so, are you leveraging those relationships between the RI team and them to maximum effect? So I just think there's an internal assessment that needs to happen to determine what the most appropriate step forward is, depending on the governance structure of the organization, to close that skills gap, if that skills gap exists.
No, quite. And you mentioned working with sovereigns and using leverage there. And I think perhaps on the next question, I'd like to broaden that out to bondholder influence more broadly. How is TPP use? You're working with Invesco now as on the fixed income side. How are you leveraging your influence with those bond holdings?
So I think in terms of our monitoring program and what would constitute effective bondholder influence, there's a few areas that asset owners can focus on. First of all is around proactive engagement. So engaging with issuers before debt issuance, during roadshows and in pre-issuance meetings to raise ESG concerns. And also aligning the bond and equity stewardship programs where possible. Obviously, if it's a pure play bond manager, that might be tricky. But if they are both a bond and equity fund manager, leveraging the bond and equity stewardship program where possible to strengthen that signal to companies and avoid conflicting messages. And then the next thing would be assessing covenants, so scrutinizing bond covenants for robust ESG terms. And then, of course, which this is similar to equities, having a robust escalation policy when engagement is not meeting expectations. This could include direct discussions with board members, public statements, or in extreme cases, divestment or reducing the holding. And then probably last but not least, but is engaging the wider ecosystem, right? Encouraging banks and credit agencies to integrate ESG into their decision-making processes. This is really important, and it forms part of that systems thinking piece, right? If there are barriers in the wider financial ecosystem that are reducing the likelihood of company engagement success, they need to be addressed in parallel. And then in terms of Invesco and our relationship with them more specifically, at a product level, Invesco is a strong strategic partner for us when it comes to responsible investment. They have committed to undertaking a bespoke engagement program that's aligned to our stewardship priorities, and I think that's quite unique in the industry, for which they deserve a lot of credit.
Now, throughout the conversation so far, there's been a kind of a thread, I think, of we know that we're further addressing systemic issues, systemic risks, and needing to go to the root of the kind of issue, and very often that involves more and more focus on policies of governments rather than the actions of corporates in our portfolio. And I just wanted to turn to how that's a very evolving picture, particularly in the US. You like many other asset owners have kind of large exposures. We've just seen the endangerment finding repeal is the latest move in terms of withdrawal from climate regulation by the Trump administration, and that's been accompanied by an ongoing actions by the SEC to limit investor voice on a variety of issues, not just on sustainability issues. So within that context, I'm just wondering, what are the practical implications for asset owners in using their influence and leveraging their relationships in the context of their US holdings?
Yeah, it's such a tricky area. I think overall, an appropriate balance needs to be struck so that you're neither overreacting and not jumping to the worst possible scenario immediately, as there are still guardrails in place to protect shareholder rights on the one hand, and then on the other hand, not underreacting to potential future erosion to shareholder rights. So no matter what happens in the future on this, I think we and asset owners need to stand firm with asset managers now more than ever on how they engage and vote with companies, and as well as how they engage with industry groups and regulators in the US. And as part of their monitoring program, asset owners can also formally ask for regular reports, like a RAG status, for example, on how US developments may impact upon the delivery of their mandate requirements. And this is not to release externally managed asset owners from their own obligations in this area, but our fund managers are at the coalface of this issue, more so than we are. And so I feel that the primary lever for us is through our monitoring program with them.
Overall, I mean, it's quite clear that asset managers are listening to their asset owner clients, but they have a complex a number of different relationships and different kind of perspectives to manage. I mean, to a certain extent, you always want to be pushing them in the direction that you want to, but it's they do have a complex situation to manage, don't they?
Yeah, it's such a tricky area. I think an appropriate balance needs to be struck so that you're neither on the one hand overreacting and not jumping to the worst possible scenario immediately, as there are still guardrails in place to protect shareholder rights, and on the other hand, not underreacting to potential future erosions to shareholder rights. But no matter where this goes in the future, we as asset owners need to stand firm with asset managers now more than ever on how they engage and vote with companies, on how they engage with industry groups and regulators in the US. And then as part of their monitoring program, asset owners can also formally ask for regular reports, like a RAG status, for example, on how US developments may impact upon the delivery of their mandate requirements when it comes to responsible investment. Now, this is not to release responsibility from externally managed asset owners from their own obligations to assessing this themselves, or indeed getting involved in industry and policy engagement activities. But our fund managers are at the coalface of this more so than we are. And so I feel that the primary lever to address this is through our own monitoring program with them.
Mm-hmm. And it's certainly been said to me that U.S. asset managers in particular really are between a rock and a hard place right now, and probably deserve a modicum of sympathy.
I absolutely agree with that. And I think we have a role as asset owners that when we're setting expectations, yes, I believe they should be stretching, but they need to be stretching within the context of the operating environment in which that fund manager sits.
Absolutely, absolutely. Well, Leanne Clements of the People's Partnership, thank you very much.
Thank you very much for having me, Chris.